Hi, this is Arnav from Scale and welcome to yet another episode of Refactor. And in this episode, I'm going to be talking about something that a lot of people ask when they're getting job offers from startups, which is how do we evaluate our ESOPs, right? So in this video, I'll break it down in multiple parts. So first of all, we'll talk about what are ESOPs actually, how do they work out. Then we will discuss about how should you look at the trade-off between maybe taking a salary cut and ESOPs, or like how do you value ESOPs as part of your compensation package. Next, we'll talk about what are the outcomes of getting ESOPs, like how do they grow, what can happen if your company gets acquired and everything. And finally, we will talk about what are some of the good ESOP policies that startups have, which you can filter for that whether I should join the startup because they have a good ESOP policy. Okay. So first of all, let's start off with understanding what ESOPs are, and the terminology means employee stock option plan. So what happens is like a startup begins and there are some founders, 2, 3 people who have started the company and they own probably 3 founders, 1/3 of the company each. And then they might raise some investment, and then whoever is investing into the company, they end up taking some of the shares. So what happens is in companies, usually the investor does not take any existing shares. The company issues new shares. So if everybody had, like, let's say there are 2 founders having 500 shares in the company, 50%, 1,000 shares of the company, and some investor comes and the investor invests, say, 1 crore rupees, and 500 new shares are issued to that company, right? So what happens is that investor now owns 1/3 of the company, because there is 500 to founder A, 500 to founder B, and 500 new shares issued to that investor. So there are 1,500 shares of the company, and everybody has 33% of that. And the company maybe bought that at 1 crore. So 1/3 of the company is worth 1 crore. It means that. And which means that the rest of the company was worth another 2 crore, because 500 shares is worth 1 crore. So the rest, the 1,000 shares are worth 2 crores. So the valuation of the company is now 3 crores. And these founders who actually did not have anything of any particular value so far, but because this investment, I mean, what they had was of definitely value, but that value was not actually in real hard numbers so far. Nobody knew what that value was, but this investor ended up valuing that existing amount at 2 crores, and they bought 500 new shares, so 1 crore. So the company's total valuation is now 3 crores. Okay. Now what happens is that companies, when they're raising funding, they would be having other employees as well. And for an employee joining an early stage company, you would want them to also have some part in that company if the company grows and becomes successful. So that is where people grant ESOPs. Now ESOPs are not actually shares. The reason being that if you join a company and if you are given some shares, actually shares get transferred to you, then according to the government, you have earned that amount of money because those shares have some value. So if there's a company whose each share is of 100,000 rupees worth or $100,000 worth. So if one of those shares is transferred to you, because shares are like actually whatever you trade on the stock market, shares are like securities, right? So they have an actual rupee dollar value associated to it. So if you get something granted, then you have to pay the income tax on it. But the problem with that is, of course, you can't sell that share immediately because that company is not in the public market. So that you don't have to pay income tax on shares, what you get is an ESOP. An ESOP means that today the shares are worth, let's say, 1 lakh rupees. Okay. I'll give you 3 such shares, which means I have given you something which is worth 3 lakhs. But I'm not transferring that shares to you right now. What I'm telling you is that in any day in the future, if you want to buy shares, you can buy up to 3 shares at this 1 lakh price point itself, because you just got the option to buy 3 shares at this 1 lakh price. Like 10 years later, if our company's shares are worth 1 crore rupees, you will still be able to buy the shares at 3 lakhs. So that's what basically an ESOP means. So it is a way to defer the tax, but still giving people the shares, but you don't really get it. You get an option to buy it. And how do people actually get value out of that ESOPs? So if a company goes on to IPO, for example, Zomato did IPO, and there are people who have worked at Zomato, and I have worked at Zomato as well. People who have worked at Zomato, they had some ESOPs. So once the company does go public, what you can then choose to do is you can actually choose to first buy your ESOPs and they become yours, and then sell it. So usually it happens in a single transaction. So for that case of where a share is worth 1 lakh and now it becomes worth 1 crore, what you will actually get is the difference between those two things, because you can buy that share for 1 lakh rupees and then sell it for 1 crore, and that's the difference that you will get. There is another interesting part that comes in that ESOP discussion is what's a strike price. A strike price means that how much do you have to pay to actually buy. So the best ESOP policies, the strike price is usually close to zero, which means that the strike price is only a nominal amount, which for legal, compliance, financial reasons, there has to be some value, and it could be $1 or 1 rupee or something like that. So you have got 500 shares allocated. The shares are worth already, like the day they were allocated, they were already worth maybe $1,000, $5,000 or something. But you have a strike price of $1, which means the day you want to own those shares, you can pay $1 and buy those shares, right? So that's what ESOPs are, and they're a little different from another term which is called RSUs. RSUs are generally given to you by companies which already have stocks which are trading in the public. So you get restricted stock units. The only reason the word R is there, restricted is there, because as an employee, when you get stocks from a company, you also have inside information about that company, like what's new getting to be released. You can also see maybe data of business metrics and everything. So these stock units that an employee gets, they can't sell it and buy it on a day-to-day basis. So if I'm working at Google on any share trading app, I can't buy and sell Google stocks. Okay. So your stock units are called restricted because then you can buy and sell it only in certain windows. So usually every quarter or once in a year, you get a window, and you can preset, like before the window, you need to tell the stock exchange that I have 50 shares of Google, I want to sell it on this date, and on that date automatically will get sold for you. That's the reason they are called RSUs, but those are actual shares that are transferred to you versus ESOPs, which you get in startups. Okay. Now the question is that how do you value an ESOP, right? So there are a lot of frameworks to it, and a lot of people who have worked at startups have their own little benchmarks around it. The one important thing is a lot of times if you're coming from a larger company to a smaller startup, you might lose out on two things. One is that maybe the new company is also giving you a lot of ESOPs, but that larger company had RSUs which you could sell very easily, like at least once a quarter, once a year. It's very liquid, like cash only. Like if you work at Microsoft and you get every year Microsoft stocks, you can sell it every year, and that's exactly like money. But stocks that you get from a startup, you can't sell it immediately. You might be able to sell it at some future funding round where the startup allows some employees to sell some of their shares to the investors, or when the company actually IPOs, and which could be 5 years or 10 years away from now. There are rarely any companies which IPO less than 5 years from founding, less than 10 years also. There's a lot of companies you will see they are IPOing today. They have been founded in 2010, 2012, 10 years back, right? So you are losing out on liquidity as well. Like whatever you're getting of value in ESOPs, it's not liquid. So whatever you will actually take home every year in terms of financial amount is only going to be your salary, not the ESOP part. And a lot of times what happens is, like when you're coming from a large company to small, your salary component is also, you might have to go down a bit in numbers. Like maybe you had a 20 lakh salary and you're going to some place with 15 lakh salary. So you are reducing a little bit on the salary component as well, right? So you're letting go of these things. But why you might be going for? Because the ESOPs that you get today, they might become 100x or 1000x in value. Because a small startup, if it actually gets successful, the value increases tremendously. Like say Google's market capitalization or value, like Google or Amazon, they are at $1 trillion, $1.5 trillion, the size of the company today. And they were at $1 trillion 3 years back as well. Right. The size of these companies, they don't become 10x or 100x within 5 or 6 years because they have reached the maximum possible size a company can reach. Right. Versus a startup, which it starts out today and they become successful. The company could be valued at $1 billion today, then $10 billion, then $100 billion. Right. When you join a very early stage startup, you're joining it when the company itself is valued at, say, $100 million or $10 million. Right. So the upside is very large, but also not all startups succeed. So your value of ESOPs could be zero if the company shuts down. And during this, recent few months where, there has been a little bit of drought in funding, the share markets have collapsed a little bit, a few months of recession was happening. So during that time, a lot of companies did actually shut down, startups. And everybody who had ESOPs in those companies, their ESOPs are not worth anything. So there is a high upside, but there is also a high risk because the probability that your ESOPs would mean crores and crores of rupees is not guaranteed. So for the first I would say, framework of understanding like how to value the ESOPs is a very personal thing. Is that, do you believe in that startup? Do you think that this idea will actually work out? If you don't think so, then you should consider the value of your ESOPs to be zero, because you don't believe this company will work out. So you have to ascribe a p number, a probability number, to whether your ESOPs would be valuable or not. And if this probability in your mind is zero, then your ESOPs worth is zero, because this p gets multiplied, right, with your ESOPs worth. If you at least personally are 100% sure this company will definitely succeed and it will definitely grow, then your p number is at least 1. So then we will move on to the next parts of the equation. But let's understand, the very first thing is that there's a probability number associated with it versus stocks of a public company where you definitely get it. And there is also the probability that the company stock can go up and down by the time you get to sell it, but still it will be within 1 year. And like Microsoft stock is not going to become $0 value within a year, right? Now, the next part is, how much should you trade off your salaries? And there, at least my personal little framework is that you should not be going somewhere where from your previous salary you are letting go of more than 50% of it. Like, let's say you had a 30 lakh salary somewhere, and you go somewhere where it's 15 lakhs. That's not a good deal, because you probably would have your expenses and your lifestyle, everything set up around a 30 lakh salary so far, and you might be spending almost 15 lakhs already. Like most of the people, I mean, it's a good idea though to save at least 50% and then spend less than 50% of what you earn. It's fairly possible that you were spending 50% of what you were earning. So taking a 50% salary cut means that a lot of things will change in your life, which is a bit risky, a bit uncomfortable, something that will always be in your mind all the time. You will think that, hey, I left 50% salary cut to come this place. So that's not in a good place to be in a startup where you're thinking in a psychological financial pressure that you have for yourself. Okay. What is better is, if your salary cut, if there is no salary cut, that's also possible. Like I have moved to larger companies, to startups in my life as well, where the startup said that, okay, whatever you were getting paid in the last company, we can pay you the same amount. We won't be able to give you an increment, but we can pay you the same amount. If that happens, that's great, of course. All right. People have generally expectation when they're switching jobs that the salary will go up. Versus that, if it does not even go up, if it stays same, then also it's great. But if it does come down, maybe 15-20%, that should be a reasonable amount of compensation that you're letting go, so that you are basically buying into the upside of the ESOPs. But the risk is also there, so you should not let go of your entire salary to do something like that. Founders do that. Founders start a company with zero salary on day one. The reason they do that, because they're taking up the entire risk, and that's why their equity in the company to start off with, if there are two founders, is 50-50%. Even after a round of funding, it could be 30-30%, right? Versus your ESOPs are not going to be 30%, 50%. So that's the, I would say the lower threshold that you need to set up on the salary side of things. Next, how much ESOPs you're getting. Now, it's very subjective and it depends on a lot of things in the situation, but I will tell you that for somebody, at least I'm talking about tech, and I won't be able to talk much about other things, but at least in tech, if you're joining a tech company and the founders are non-tech, the founders are looking at marketing, sales, product and stuff like that, and you would be the most senior tech person, like they're hiring you as there are a lot of names for the role, founding engineer, head of engineering, or even CTO if you're hiring as that. Then if the company has not raised more than 2 rounds of funding, like if it's not a Series B, C funded company, which has raised already more than $10-50 million of funding, then if they're hiring somebody to be leading an entire vertical of that company, like a CTO kind of a thing, then your ESOPs, the net value of it will vest over time, should be something in the ballpark of 2-3%, maybe up to 5% also possible. I have seen that, but that's more on the higher end, but at least 2%. Anything below 1% would be a little suspicious to me. The other way around is if the company has a tech co-founder already. So you are not really the be all and end all of tech decisions in that company, but you're still being hired to lead one vertical inside tech. Let's say you would be the most senior backend engineer, or you would be the most senior front-end engineer when you are joining the company. And you have a few years of experience for that as well, and you'll be leading a team, you'll be building a team. In that cases, the ballpark is 0.5%, I would say, to 0.2%, 0.2 to 0.5%, and it can go down to 0.1%. But if it is 0.00 some percent range, then again it's a bit of a sour deal in that case. should be point single decimal percentage places is what your ESOP should be in percentage terms, right? Next, let's talk a bit about how your ESOPs do grow when your company raises funding. A little bit of misconception people might have, and I recently did a poll on Twitter. If you follow on Twitter, you might have seen that. Is I asked that if you have 20 lakhs worth of ESOPs in a company, and it raises some funding because of which the valuation becomes 4 times. Like the company was valued at $100 million, and you had 20 lakhs worth of ESOPs there, and the company valuation went from $100 million to $400 million. What would your ESOPs be? And most people voted 80 lakhs, which is actually wrong. Your ESOPs don't grow with direct multiples of your company's valuation, because if you remember the example that I was just talking about, when a company gets funded 1 crore rupees, or let's just say, let's use dollar values like $1 million, and the investor buys 500 shares, while the company already had 1,000 shares. The company consisted of 1,000 shares, buy 500 shares. So this is worth 1 million, but the rest of it then is worth 2 million, because if 500 shares of a company is worth 1 million, then 1,500 shares of that company is worth $3 million, right? Now, if you were part of that 1,000 shares, right? Whatever was your worth, it does not become 3x. It becomes, whatever is like 2x or less than that of that new value. Because when a company gets funded, the new valuation, there are two numbers to it: the post-money valuation and the pre-money valuation. So if a company had a valuation of $100 million and it raised funding of $100 million more, right? $100 million in funding of a company which is valued at 100 million, and the new valuation is $400 million, which means that in the new 400 million sum, out of that, 100 is the new money that came in, 300 is the value of the existing company, right? So whoever invested money in this company now believes that this company, the earlier version of the company, which was worth $100 million, has now become worth $300 million, and they have purchased more shares for $100 more million. So total valuation is 400 million. Which means that if people who already had shares in that company, if they had 20 lakhs worth of ESOPs in it, their ESOPs become 60 lakhs worth, not 80 lakhs worth, right? So if your company becomes 100x in size over 3-4 rounds of funding in the next 10 years, your ESOPs will probably not become 100x for sure. It will become maybe closer to something like 20 or 25x, because every round there will be some dilution, and later stage round sometimes there is more dilution. Anyway, these are more detailed discussions and lots of finance and mathematics, but you just get an idea that just because your company is valued something, the multiples won't directly impact your ESOPs. They will grow a little more slowly than your company's valuation. The same thing happens with the founder's equity as well, by the way, just because that's how dilution works. The other part is like how big your company already is and how big the market is. So if your company is in a market where the total audience is 1 million users only, and every user would be spending 100,000 rupees max in that particular segment, it's a $10 billion market. So the company's valuation can never be more than $10 billion, because they are in a market which is of $10 billion size itself, right? So Google is $1 trillion because Google is in a market where everybody is searching, and they're going to be keep on searching every day, and it's a huge market. So people think that Google has the potential to earn, over Google company's lifetime, they will probably earn so much money that the company's value can be $1 trillion today, right? But not all segments can be $1 trillion. So there are segments where a company, the largest possible company, could be of $10 billion size only. So if you're in a company where the shares you're getting, what is the valuation of the company currently? If it's already too big, then there isn't a lot of scope of the valuation going 100x very easily. So that's also something that you should keep in mind. So if you're joining a company which is valued at $10 million and they're in a space where the market is very big, it's possible that your ESOPs can 100x, even 1000x. But if you're joining a startup which already has $2 billion valuation and the market is not all that big, then it's fairly possible that your ESOPs will not even 2x over time. So keep that in mind. Now, finally, we'll talk about some ESOP policies that you should look out for to get an understanding of whether that company is good in terms of ESOP distribution or not. So ESOPs generally vest. You don't get the ESOPs on day one. In India, there is a legal rule which means ESOPs can't be granted within the first year. So your ESOPs will start vesting from after at least 12 months of your joining, which is called the cliff basically. So your first set of ESOPs will vest 1 year later, and then it will keep on vesting after that. Some companies design ESOPs in a way which is called ununiform vesting, where staggered vesting, where after the first year, you get only 10% of your ESOPs. After the second year, you get the next 20% of your ESOPs. After the third year, you get the next 30% of your ESOPs, right? And in the fourth year, you get the next 40% of your ESOPs. So you get your 100% of your ESOPs over 4 years, but you don't get 25, 25, 25, 25. You get 10, 20, 30, 40, which is not a good policy. I mean, the company might be looking at a better way to retain somebody for 3 years or 4 years rather than 1 year. But nevertheless, better companies would have ESOP policies where you get 25, 25, 25, 25, right? The other piece is also some companies where the ESOP vesting schedule is annual, like every year end you get the next vesting. But there are companies where the vesting could be even more frequent. Like there are companies, I think Uber, which had done daily vesting, where how many ESOPs do I have? There's a dashboard which would update the number every day, right? That's a little overkill, but there are a lot of companies who do it at least at a monthly level, which is actually good, I feel, because after the first year, from 0 to 12 months, no vesting will happen. But from the 12-month period, from there on, if it's vesting at least monthly or if at least quarterly, then that's better than annually. Okay. Finally, look at the track record of that company or of those founders. Have they done ESOP buybacks before? What happens is that the company is growing very well. They have a lot of cash in the bank, and potentially if they are profitable, then people who have been granted ESOPs in the past, in the next funding round, some of the ESOPs the company can buy back from them. A buyback is good because you can get some liquidity from your ESOPs. You don't need to hold your ESOPs till the day of the IPO. Even before the IPO, if your company is doing good business, the company can say, okay, you have 10 lakh worth of ESOPs. What I can do is I can buy 10% of your ESOPs back from you and I can pay you 1 lakh rupees. So that ESOP that you have earned so far, you actually get some financial outcome out of it. It's good for the company also. If it's a profitable company, it can buy back some of those shares back from some of the early employees who had a lot of shares, and then they can use it to distribute ESOPs for future employees as well, right? Which is obviously a good thing if a company does. So definitely look out for companies or for founders who have done that. There are a lot of Indian startups who have done ESOP buybacks. In fact, we at Scalar recently, before our last funding round, we had done ESOP buybacks. And companies which do that are definitely having a good ESOP policy. So keep in mind these ESOP policies to look for better companies with good ESOP policies. And you would know that they are going to be looking out for employees more. And apart from that, keep in mind the risk associated, and then keep in mind how much of compensation you're letting go to sort of buying into the future of that company, and how much do you believe in that. Okay. For more tips on how to look at ESOPs, negotiate job offers, or technical topics as well, stay tuned to the Refactor series on Scalar's YouTube channel. Please do subscribe to us, and we will be making more and more videos on this. Definitely leave some comments if you would want us to talk about some other topics as well. We can definitely make videos on that as well. Thank you so much for watching.